Welcome back. We are joined now by Martin Pelletier, Senior Portfolio Manager at Trivest Wealth at Wellington-Altus Private Counsel. Martin, thanks as always for checking in with us. Love the hat, by the way. I guess we're getting close to Stampede season in Calgary. We're going to talk about the U.S. stock market in this segment. We're going to take a break and come back to talk to you about the Canadian stock market. We began our program this morning talking to one of your peers. She expects a strong second quarter U.S. earnings season, and she expects it to cast a spotlight on non-technology areas of the U.S. market and how well some of those companies are performing. Do you expect the same thing?
Yeah, I wouldn't disagree. If you look at the market breadth, it's really paired by the variance in earnings. So, for example, if you take a look at the last 5 consecutive quarters, the Mag 7 contributed probably the majority of the earnings growth that we saw from the S&P 500, while the S&P 493 have been flattened down. So, for example, the Mag 7 grew their earnings by 52% in the first quarter year over year, while they call it the Maleficent 493 grew by only 1%. Now, that's yesterday's news. What's tomorrow's news as we get into Q2? Q2 is expected to post the first quarter growth in these 493. And we're seeing that by some of the forward earnings projections, and we're seeing some positive 3-month percentage changes marked by some of the charts that we've seen showing that it's increasing up to maybe about 83% from 40% as of this week. And so the expectations are there. I don't think it's translated into the market performance, but if they do deliver, there's some opportunity.
What are you expecting from bellwethers like General Electric, Caterpillar, John Deere, FedEx, and so on, companies that, when they report, seem to certainly have the capacity to tell us more about the macro environment?
Well, I mean, their share prices, interestingly enough, if you look at like GE, CAT, or Uber, they're up 13.5% still year over year, and yet their earnings are expected to be slightly negative on the growth side from June of last year. And so hopefully they can deliver because there's some strong expectations there. What's really interesting is in the small cap space, because if you take a look at the S&P, it's gained 4.2% in the first quarter, while the average stock is down 2.6%. That's only happened 5 times in the past 3 decades. And now U.S. small cap stocks are down 2% on the year, while large caps are up 15%, the strongest outperformance since 1998. And so I think it's very important to go down market into some of the small cap names, which would be large cap in Canada.
You say that there is opportunity for those willing to diverge from the herd, in other words, to diverge from the Magnificent Seven or Super Six, or however we term them these days, to get into other sectors. How important do you think it is that investors do exactly that?
Well, so everyone's been performance chasing, and there's something called career risk. So as a fund manager or a investment advisor, you're going to have to keep track to whatever's the top performing benchmark is, and that's the S&P 500. And because the S&P is highly concentrated in these Mag 7 stocks, you got 10 stocks that represent 34% of the index. Anytime we got anywhere close to this was back in 1963. And so people by default are chasing the S&P 500, which is dominated by those big names. Then you're looking at things like 3 times levered NVIDIA, ETP, that's the largest, the most traded product in the London Stock Exchange. So there's a lot of FOMO chasing going on, and that's just, as an investor, not and a portfolio manager and a fund manager, that's just not what we're up to. And I think there's some opportunities. If you look at healthcare, for example, in the U.S., Eli Lilly, United Health Group, Johnson & Johnson, they're expected to post a year-over-year earnings gain of almost 17%, but the share prices are up only 9.8%. Energy, Exxon, Chevron, ConocoPhillips in the U.S., the earnings are expected to grow by 13 to 14%, and yet the share prices are only up 10 to 11%. And so, if you take a look at other segments of the market, like the Mag 7, for example, their share prices are up 65% year over year, and yet their earnings are expected to be 30 to 40% growth. So there's been a multiple expansion in those companies.